Hey everyone, and welcome back to the Safe, Simple Sound podcast. I'm your host, Alex. It's great to have you tuning in as we continue our journey towards financial clarity and control. Today, we're tackling a topic that comes up every year, but can still feel like a bit of a maze: tax deductions, specifically for homeowners and those of us who like to give back through charitable donations. Our discussion is grounded in research that decodes some key areas, looking closely at guidance typically found in IRS resources like Publication 17 and the specific publications it points to for details. The core idea we're exploring is how to navigate your tax options effectively to potentially lower your bill. A couple of big takeaways from looking into this. First, understanding the critical choice between taking the standard deduction versus going through your expenses for itemized deductions is absolutely foundational. Second, even when you can deduct things like state and local taxes or mortgage interest, there are specific rules and limitations, like the SALT Deduction Cap, that you really need to be aware of. And that's exactly what we'll be breaking down today, making these complex topics safe, simple, and sound. We want to empower you, aligning with our belief in helping you seize financial control and truly understand your financial choices, especially when tax season rolls around. Yeah, tax season. That time of year that can feel a bit like trying to solve a Rubik's Cube blindfolded, right? Especially when it comes to deductions. But here's the good news. For many people, especially homeowners and those who are generous with charitable contribution deductions, understanding these breaks can make a real difference to your bottom line. So where do we start? We start with the absolute foundation, the big fork in the road you encounter when filing your federal income taxes. Choosing between the standard deduction and taking itemized deductions. Think of the standard deduction like a fixed-price meal deal offered by the IRS. It's a set dollar amount, and it actually increased again for 2024, which is great news for many taxpayers. The amount depends on your filing status, single, married, filing jointly, etc. You take this deduction, no questions asked about specific expenses, and it directly reduces your taxable income. Simple, straightforward. But then there's the a la carte option, itemized deductions. This is where you don't take that fixed meal deal. Instead, you tally up a list of specific eligible expenses you paid during the year. These get listed on a specific form, Schedule A. Now, why would someone skip the simple standard deduction? Well, if the total value of your specific deductible expenses, your a la carte items, adds up to more than the standard deduction amount, choosing to itemize could lower your tax bill even further. And this is where homeowners and frequent donors often perk up. Why? Because they tend to have some potentially hefty deductible expenses that others might not. Think about things like the mortgage interest deduction on your home loan, or the state and local taxes you pay, often called the SALT deduction, which includes things like property tax deductions. And of course, those significant charitable contribution deductions many people make throughout the year. So, the crucial decision point comes down to simple math, really. You need to compare. What's the standard deduction 2024 amount for my filing status? And what's the total of all my potential itemized deductions? Add up your estimates for things like qualifying mortgage interest, your SALT deduction, and your charitable contributions. If your itemized total looks like it will be bigger than the standard deduction, then itemizing is probably the path you want to explore further. You might be thinking, but Alex, didn't you just say the standard deductions are higher now? Yes, they are. And that means fewer people itemize than in the past. However, for those with substantial homeowner tax deductions like mortgage interest on a sizable loan, or those living in areas with high state and local taxes, or individuals who make significant charitable contributions, those specific expenses can still easily add up to surpass the standard deduction threshold. That's why it's still a critical calculation for homeowners and donors. So what's the first step? It's exactly what we just talked about. Getting those two numbers side by side. Your potential standard deduction versus your estimated total itemized deductions. Over the next few segments in this episode, we're going to dive deeper into those key itemized deductions that often tip the scales for homeowners and donors. We'll unpack the SALT deduction, get into the weeds on the mortgage interest deduction rules, and explore how charitable contribution deductions work for both cash and non-cash donations. So, the big takeaway for today is understanding this fundamental choice: the simple, fixed standard deduction versus potentially more lucrative itemized deductions listed on Schedule A. For homeowners and donors, itemizing often warrants a closer look due to expenses like mortgage interest, state and local taxes, and charitable giving. Your action item for this week? Do a quick search for the standard deduction amount that applies to your filing status. Then, start gathering some rough estimates of your big potential itemized expenses from this past year. Look at your mortgage statement for interest paid, check your property tax bill, estimate your state date income tax paid or withheld, and tally up your charitable donations. Just getting those ballpark figures together is the crucial first step in figuring out which path might save you more money come tax time. All right, so last time we unpacked that big decision: sticking with the standard deduction or diving into the world of itemized deductions. If you've done some quick math and think itemizing might be the way to go, especially if you're a homeowner, one of the very first big-ticket items you'll encounter on Schedule A is the deduction for state and local taxes, often called the SALT deduction. Today, we're zeroing in on this SALT deduction. It's a significant one for many, particularly homeowners, but it also comes with a pretty major asterisk these days. We'll break down what taxes actually count towards it, discuss that big limitation everyone talks about, and consider how it affects your bottom line. So first things first, this state and local tax deduction, or SALT deduction, is one of the core itemized deductions. If you choose not to take the standard deduction and instead file Schedule A, this is often one of the first sections you'll fill out. It's particularly relevant for homeowners because a big chunk of it often relates to the property tax deduction. Now, what exactly falls under the SALT umbrella? Think of it like choosing your main course at a restaurant. You generally get to deduct either your state and local income taxes paid during the year or your state and local general sales taxes. You typically can't deduct both. Most people, especially those in states with an income tax, will deduct their state and local income taxes. That's often the amount withheld from your paycheck shown on your W-2, plus any estimated payments you made directly. However, if you live in a state with no income tax, like Texas or Florida, or perhaps you made a huge purchase like a car or boat and paid a lot of sales tax, you might find deducting your general sales taxes is more beneficial. The IRS even has tables to help estimate this, or you can use your actual receipts. Then, like adding a side dish to your meal, regardless of whether you chose income or sales tax, you also get to add in the state and local real estate or property taxes you paid on your home during the year. So the basic formula is plus state local property taxes. Okay, sounds pretty good so far, right? Especially if you live somewhere with notable income or property taxes. But here's the crucial limitation, the big hurdle introduced a few years back by the Tax Cuts and Jobs Act. There's a temporary limit, a cap, on how much total state and local tax deduction you can actually claim on your federal return. Regardless of how much you actually paid in those combined state, local income, or sales taxes plus property taxes, the maximum you can deduct on your federal return is currently capped at $10,000 per household per year. That limit drops to $5,000 if you're married but filing separately. This is the infamous SALT deduction limit you've probably heard about. So, what does this SALT deduction limit mean in practice? Well, if your total calculated SALT, let's say your state income tax was $5,000 and your property tax was $3,000, totaling $8,000, then great, you can deduct the full $8,000, assuming you're itemizing. But imagine you live in a state with relatively high income taxes and high property values. It's not uncommon for homeowners in places like California, New York, New Jersey, or Illinois, for example, to pay well over $10,000, maybe $12,000 in state income tax and $8,000 in property taxes, totaling $20,000. Because of that $10,000 cap, even though they paid $20,000 in state and local taxes, they can only deduct $10,000 of it on their federal Schedule A. This cap has really changed the game. For taxpayers in these higher tax states, it significantly reduces the benefit of this particular homeowner tax deduction. It makes itemized deductions less valuable than they might have been previously, and is a key reason why more people now find themselves taking the standard deduction, even if they own a home. Now, if you're looking for the absolute fine print, the main IRS guide, Publication 17, does introduce the concept of deducting taxes. But for the specifics on how to calculate this deduction and apply that $10,000 SALT deduction limit, the best place to look is the official instructions for Schedule A. That's where the IRS lays out the precise rules for the current tax year. This really leads to a key point for reflection, especially if you are in one of those areas where your combined state, local, and property taxes might easily exceed $10,000. How does knowing about this cap influence your decision-making around itemizing? Does hitting that $10,000 limit quickly make other potential itemized deductions, like mortgage interest or charitable donations, even more critical in determining whether itemizing beats the standard deduction for you? And thinking practically, how do you keep track of all this during the year? Do you have a good system for tracking your property tax payments? Maybe escrow payments shown on your mortgage statement or direct payments you make? And what about your state income tax? Checking your final pay stub for the year or keeping records of quarterly payments if you make them? Having these numbers readily available is key. So, let's quickly recap the key takeaways on the SALT deduction. It's a major itemized deduction found on Schedule A. It includes either state local income taxes or sales taxes, plus state local property taxes. Crucially, there's a $10,000 cap per household on the total amount you can deduct, the SALT deduction limit. This cap particularly impacts homeowner tax deductions in states with high income or property taxes and influences the choice between itemizing and the standard deduction. Check the Schedule A instructions for the most precise rules. Okay, here's your action item for this segment. Take a look back. If you itemized last year, pull out your tax return and find Schedule A. See what number you actually reported for state and local taxes. Then, grab your most recent property tax bill or statement and look at your pay stubs or estimated tax payment records to see what you've paid in state and local taxes this year so far. Get a rough idea of your total potential SALT deduction amount for the current year. Is it clearly under $10,000? Is it close? Or is it way over? Understanding where you stand relative to that $10,000 SALT deduction limit is a crucial first step in tax planning. In our last segment, we tackled the sometimes tricky state and local tax, or SALT deduction, and that important $10,000 cap. If you own a home, that's definitely one piece of the tax puzzle. But now let's shift our focus to another potentially huge piece for homeowners, something that often makes a big difference when deciding whether to itemize. I'm talking about the mortgage interest deduction. If you own your home and have a mortgage, this is definitely a topic you want to pay attention to. For many homeowners, choosing to itemize deductions rather than taking the standard deduction, the ability to deduct the interest paid on their home loan can be one of the most significant homeowner tax deductions available. It can translate into real savings on your tax bill. Now, here's where things can get a little confusing if you're just flipping through general tax guides. You might look at something like Part 3 of IRS Publication 17, which we've mentioned before, and see it talks about deducting real estate taxes. That's important, yes, but for the rules on deducting the interest you pay on your mortgage, Publication 17 actually sends you elsewhere. Think of it like getting a map. Pub 17 shows you the general area, but for the detailed street view of mortgage interest rules, you need a different guide. And that specific guide, the one the IRS points you to, is IRS Publication 936, titled Home Mortgage Interest Deduction. This is really the definitive source you need to consult. So, what kind of crucial information will you find in Publication 936? Well, it breaks down some really key concepts. For instance, it explains the difference between deductible mortgage interest on acquisition debt, that's money you borrowed to buy, build, or substantially improve your home, versus interest on home equity debt. The rules can differ. It also details the important loan limits. For most people who took out mortgages after 2017, you can generally only deduct interest on up to $750,000 of acquisition debt, or $375,000 if you're married filing separately. Have a loan from before that? The limits might be different, and Pub 936 explains that too. And it's not just the regular interest payments. Ever wonder about those points you might have paid when you first got your loan, or maybe when you refinanced? Publication 936 dives into the rules for deducting points as well, explaining when you can deduct them all at once versus spreading the deduction over the life of the loan. See? Lots of specifics in there. Okay, so you understand the potential deduction, you know where to find the rules, but how does this actually work on your tax return? Well, if you're itemizing, the mortgage interest deduction is typically reported on Schedule A. And where do you get the numbers to put on Schedule A? Your mortgage lender makes this part relatively easy by sending you a form each year, usually by late January or early February. This critical form is Form 1098, the mortgage interest statement. Have you ever really looked closely at yours? Box 1 usually shows the mortgage interest you paid during the year. You might also see information about points paid in Box 6, or maybe the outstanding mortgage principal at the start of the year. Definitely keep an eye out for that Form 1098. It's essential documentation. So why is it so important to get familiar with the details in Publication 936? Because the tax code has very specific rules around this deduction. Understanding things like the loan limits, the distinction between acquisition and home equity debt, and how points are treated ensures you claim the correct amount. It helps you maximize the homeowner tax deduction you're entitled to, accurately and confidently, without running into issues down the line. It's all about getting it right. So let's quickly recap the key takeaways for the mortgage interest deduction. 1. It can be a major tax benefit for homeowners who itemize deductions. 2. The definitive rules aren't in the main part of Pub 17. You need to consult IRS Publication 936. 3. Pub 936 covers crucial details like types of debt, loan limits, and deducting points. 4. You'll report this on Schedule A using the information provided by your lender on Form 1098. All right, here's your action item for this segment. When you have a moment, go find your most recent Form 1098 from your lender. Take a good look at the numbers reported there. Then head over to the IRS website, irs.gov, and search for Publication 936, Home Mortgage Interest Deduction. Bookmark that page. Having that official guidance readily available will be incredibly helpful as you prepare your taxes or work with a tax professional. All right, so we just unpacked the homeowner tax deduction for mortgage interest, directing you to IRS Publication 936 for those specific rules and how it ties into itemized deductions on Schedule A. Now, let's shift gears slightly, but stay within that same framework of potentially lowering your tax bill if you itemize. We're moving from expenses tied directly to owning your home to the financial aspect of generosity. Specifically, we're talking about giving back and getting back. Understanding charitable contribution deductions. If you're someone who donates to qualified charities and you choose to itemize your deductions, meaning your total itemized expenses are more than the standard deduction for your filing status, then listening closely could be really beneficial. Just like with mortgage interest, the main overview publication we've mentioned, Pub 17, essentially points us towards more detailed resources for this topic. When it comes to the rules for deducting donations to charity, your two key guides from the IRS will be IRS Publication 526, which is simply titled Charitable Contributions, and IRS Publication 561, which focuses specifically on determining the value of donated property. Think of Publication 526 as the main rulebook covering the who, what, when, and how much for donations, and Publication 561 as the essential guide for figuring out the value when you're donating things instead of cash. So, let's break down the two main types. First, cash contributions. This is probably the most common form of giving: writing a check, donating online with a credit card, even payroll deductions. Publication 526 clearly outlines the documentation needed for charitable donations made with cash. Generally, you'll need reliable proof like a bank record. Think a canceled check image or a credit card statement showing the charity's name, date, and amount, or a written receipt or acknowledgement from the charity itself. Now, there's a key distinction based on amount. For any single cash donation of $250 or more, just having the bank record isn't enough. You must get a contemporaneous written acknowledgement from the charity before you file your return. This statement needs specific info, like confirming whether you received anything in return for your donation. This brings up a really practical point, touching on one of our guiding questions. What systems can donors put in place throughout the year to ensure they have the required documentation come tax time? For cash donations, it could be as simple as creating a dedicated email folder where you save all electronic receipts immediately, or maybe a physical folder for paper receipts and acknowledgments. Some people use a specific bank account or credit card just for donations to make tracking easier on statements. The key isn't which system, but having a system that works for you so you're not scrambling for records months later. Okay, now let's talk about non-cash contributions. This is when you donate goods or property. Think clearing out closets and donating clothes, giving furniture to a local shelter, donating a car, or even stocks. Generally, if the items are in good used condition or better, you can deduct their fair market value at the time of the donation. Now, that term, fair market value, is crucial. It's defined as the price that property would sell for on the open market, what a willing buyer would pay a willing seller when both have reasonable knowledge of the relevant facts and neither is forced to buy or sell. This directly relates to our question. When donating used goods, how can individuals make a reasonable determination of fair market value, and why is referencing Publication 561 important? Honestly, determining FMV for used goods takes a little effort. It's not what you originally paid for the item. Instead, think about what that item, say a 3-year-old sofa in decent shape, would sell for today at a thrift store or consignment shop. You might research prices for similar items online or in local secondhand stores. Some charities even provide valuation guides for common items, but ultimately, the responsibility for the value claimed is yours. And this is precisely why IRS Publication 561, determining the value of donated property, is so vital. It provides guidance and examples for valuing donated property of various types. It helps you understand the factors to consider and the methods you can use. For your records with non-cash donations, you need to be diligent. Keep the receipt from the charity. Maintain a list of the items donated. Note their condition, describe how you determined the FMV for each item, and maybe even take photos. And here's another important paperwork trigger. If your total deduction for all non-cash donations in a year exceeds $500, you generally need to complete and attach IRS Form 8283, Non-Cash Charitable Contributions, to your return. So that year-round tracking system, absolutely essential for non-cash gifts too. Now, while the IRS encourages charitable giving through these deductions, there are limits. Your total charitable contribution deductions for the year generally cannot exceed 60% of your adjusted gross income. However, lower AGI limits, like 20%, 30%, or 50%, apply to certain types of contributions, such as donations of capital gain property or contributions made for the use of an organization, rather than directly to them. Publication 5 and 26 dives deep into these percentage limitations. But regardless of the amount or type of donation, the absolute cornerstone is record keeping. I can't stress this enough. Keep thorough, organized records for every single donation, cash or non-cash. If the IRS ever asks, the burden of proof is on you. Finally, where does this all fit into your tax return? Like the other itemized deductions we've discussed, such as state and local taxes and mortgage interest, your allowable charitable contribution deductions are reported on Schedule A. This is the form you file when you choose to itemize deductions instead of taking the standard deduction. So, let's quickly recap the key takeaways for charitable contribution deductions. 1. It's an itemized deduction claimed on Schedule A. 2. IRS Publication 526 is your guide for the rules on cash and non-cash contributions, documentation requirements, and AGI limits. 3. IRS Publication 561 helps you understand how to determine the fair market value when valuing donated property. 4. Meticulous documentation needed for charitable donations is non-negotiable. Keep those receipts and records organized throughout the year. Think about your own giving habits. Are you tracking your donations effectively? Could implementing a simple system now save you time and potentially tax dollars later? All right, here's your action item for this segment. Take some time this week to review your donation records for the year so far. Gather those email confirmations, check stubs, and receipts from charity drop-offs. If you've donated non-cash items, practice estimating their fair market value based on their condition and what similar items sell for. Maybe even browse a thrift store website. And most importantly, go to irs.gov and bookmark IRS Publications 526 and 561. Having easy access to the official rules on documentation, valuation, and limits is incredibly helpful. All right, that brings us to the end of today's discussion on the Safe, Simple, Sound podcast. We've spent some time unpacking those often complex tax deductions that are particularly relevant for homeowners and those who make charitable contributions. We walked through that crucial first step, understanding the difference between taking the standard deduction versus potentially lowering your tax bill further with itemized deductions listed on Schedule A. Remember, comparing those two numbers is key. We specifically dove into navigating the SALT Deduction Cap, that $10,000 limit on state and local taxes, including property tax, which impacts so many homeowners. Unlocking the mortgage interest deduction, highlighting the importance of checking the right resource, IRS Publication 936, for the specific rules. And understanding charitable contribution deductions, emphasizing the need for good records and knowing where to look for guidance on cash and non-cash donations. I think grasping the impact of that SALT deduction limit and knowing exactly which specific IRS publications hold the detailed rules for major homeowner tax deductions 2024 like mortgage interest are incredibly empowering takeaways. It's all about making these rules feel less like a maze and more like a map. Our goal here is always to make these financial topics feel safe, simple, and sound, equipping you to seize financial control and truly understand your financial choices. Thank you so much for tuning in and spending your valuable time with us today. I truly appreciate you being part of the Safe, Simple, Sound community. We'll be back soon with another episode focused on clarifying your financial world. Until then, stay informed, stay empowered, and keep making those sound financial decisions. This is Alex, signing off.